The foundation of accounting is a very simple equation. Assets equals liabilities plus owner's equity. The left side of the equation shows what a company has, its assets or resources, from cash to equipment to land. Also included would be accounts receivable, money that someone owes us that we will receive in the future. And notes receivable would be a more formal version that's drawn up in a contract and usually involves interest. The right side of the equation shows where all those resources came from, whether invested in the company by owners or through debt. So just like you may have a house, but 80% of it is owned by the bank, a company's resources may have been partly obtained by borrowing from the bank or others. The two sides of the equation will always equal each other because they're actually two views of the same company. So just like we could view an apple from the top and from the side, we can view a company by what it has and where it all came from. Now, liabilities would include accounts payable, money that we're going to have to pay someone in the future because we bought something on credit. And also notes payable, again a more formal version that's drawn up in a contract with interest charges. Ownership is considered residual because it literally equals assets minus liabilities. In other words, we have to use our assets to pay our creditors first, and the owners get what is left. Now, ownership takes two forms. Original ownership is called common stock. This is the amount of money paid to a company in return for its shares of stock. Stockholders are the owners of the company. Retained earnings are the accumulated profits that a company accumulates over time. As the company is profitable, the pie gets bigger and the owner's investment grows as well in the form of retained earnings. Revenues will increase our accumulated profits and expenses will decrease them. So they would both fall under retained earnings. Every transaction that a company engages in will keep this equation in balance. Either we purchase land for cash, trading one asset for another, or we purchase land on credit, which would increase both the asset side and the liability side. So what if we purchase supplies on account? Well, that would increase the asset supplies, and it would also increase the liability accounts payable. Perform services but our customer still owes us? Well, that would increase our asset accounts receivable, since we'll be receiving more money in the future. And performing services means we've earned revenue, which is going to increase our retained earnings, a part of owner's equity. Pay a bill we owe? That's going to decrease cash, an asset, and also decrease the liability, accounts payable, since we no longer owe that amount. Collect from a customer? That's going to increase our asset cash, and it's going to decrease our asset accounts receivable because we'll no longer be receiving that money in the future. You'll find that the balance sheet is simply an extension of this equation, showing the company's resources equal its debt and equity at a single point in time, whereas the income statement is going to track our revenues and expenses over a period of time.